Hi, welcome to the final video in the series on equity. It's all very nice to know all of the theory, but you know what it's like in an accounting course. At some point, you've got to be able to crunch the numbers. So we're going to look at how you determine the amount of dividend that's distributed to the common shareholders versus the preferred shareholders. We're going to do that using this example. So we have a company and we see that they have authorized 100,000 shares, but I'm sure you remember that this is the important number. They issued 20,000 shares. So while we're looking at this information, I just want you to notice that we can calculate the average cost per share. 600,000 divided by 20,000 is $30. The common shares, they were authorized an unlimited number of common shares, but they have issued 70,000 shares. And again, we can calculate that average cost to be $20 per share. In this question, we have some contributed surplus. And you remember from other videos and from your reading that the contributed surplus may have arisen from perhaps some subscription shares that were not fully paid for, and the company retained the down payment or the payments that were made. Here we're looking though at the dividend situation, and we start off with some additional information that the preferred dividends were not paid during the preceding 2 years. And you need to look for that sometimes, to be careful. The corporation has declared $500,000 in dividends, and we know that the preferred shares are non-cumulative, non-participating. So the first thing we're going to do is determine the dividend rate for the preferred shareholders. It turns out that we're not going to actually need it in this particular question, but now's a good time as any to show you how to do it. I said that the average price per share for the preferred shares was $30, and the dividend rate was $1.50. So if you take $1.50 and divide it by 30, you get 5%. You could have done that with the total amount of dividends, in other words, the $1.50 times 20,000 shares, and then compared that to the total 600,000. You'll get the same answer. Okay, so these preferred shares are non-cumulative, non-participating. Let's carry on. I'm going to use the worksheet. I think it's useful. Again, the worksheet is not the answer to the question. It's not even required, but it's a useful tool. And so I recommend that you familiarize yourself with the layout and how it's organized, and it'll guide your thought processes. So the preferred shares, non-cumulative, non-participating, 500,000 to be distributed. There were no dividends in arrears because they're non-cumulative. So we calculate the current dividend, 20,000 shares at $1.50. We can see $30,000. That goes then to the preferred shareholders. Everything else goes to the common shareholders. Tickety-boo. The journal entry is payable to the common shareholders, $470,000, and payable to the preferred shareholders, $30,000, and the whole amount is accounted for. The journal entry, I remind you, important to me, I need to see that you know that it's retained earnings, and I think that writing it this way is a great way of doing it. Retained earnings, comma, brackets, dividends. Okay? Easy breezy. Same exact question, except now the preferred shares are cumulative, still non-participating. Still working on the worksheet, 500,000 dividends declared. This is the amount that's to be distributed. And now we simply calculate the dividend in arrears, and we see that it's still the $1.50 for 20,000 shares times the 2 years. Current dividend, 30,000. People say, well, could I combine those? Yeah, sure, go ahead. Don't have a problem with it. Paid to common shareholders, then everything else. Journal entry would be exactly the same as before. Remember that, again, from an academic point of view, to demonstrate what you know, make sure that you show dividends payable common, dividends payable preferred, rather than just a lump sum of dividends payable. Let's ramp it up a little bit more. So now we've got preferred shares that are cumulative and fully participating. What we mean by participating is that the preferred shares are now participating in the earnings along with the common shareholders. Normally they don't. Normally they get just their dividends. But where they're participating, anything above and beyond the preferred dividends as stated is allocated between both the common and the preferred shareholders. So this is the same as before, $60,000, 2 years in arrear, current dividends, $30,000. Now the next thing you do is I like to say, make the common shareholders even. Give them the same dividend that you gave to the preferred shareholders at the percentage. So the total amount of the common shareholders were $1,400,000. I'll just go back here, this number here, at 5%. Comes out to $70,000. That leaves us with $340,000 to allocate between the two, and we do that on a pro rata basis. And again, what we're looking at is the dollar amounts in the equity section. Preferred shareholders had 600,000 of preferred shares, so they're entitled to 6/20. The common shareholders are entitled to 14/20. There's no particular reason to try and bring that down to a percentage. It's not necessary. Here's the dollar amounts then. You'll notice, of course, that once you've done it for the preferred shareholders, the remaining amount, $238,000, is going to be paid out to the common shareholders. But I suggest that you do the math for each because it gives you an opportunity to catch any mistakes you might have made. Sorry, there's a little error on the slide here. Let me just take that out. They're cumulative and participating. And that's really it. Like everything else, it can get a little bit more complicated and messy. Often the questions are made more complicated just simply in the way they're presented to you. So focus on what you need to know to answer the question and then find it. Thanks very much for your attention, and I hope you have some fun with this.